Hello everyone, welcome back to my channel. So this video marks the end of the week number 79 in this road to 100k realized return challenge, and I'm posting the video a little bit later than usual because for some reason I could not access the platform. I could not log in, but now apparently the issue is solved, so now I'm able to give you an update of what has been going on during the week. First of all, and has been our modus operandi, let's start by the developments that took place over this week. And so if we look here, this was the major economic data that was released, so nothing to be concerned about on Monday. This of course was part of our I did not mention anything about the durable goods orders in the previous video, but this was a good sign. Apparently, they exceeded not only the expectations, but also it was a stark contrast with the previous month. So an increase on the core side, minus transportation 0.5 and 5.3 across the board for all durable goods orders. This is a very good sign. It would reflect a sign that there is some increasing confidence in the economy, but keep in mind this is a delayed report because it's for the November period because of the shutdown, the recent government shutdown, and so the importance of this data is of less importance specifically because of that. Now, in a stark contrast with the apparent increasing or improving consumer confidence, came the actual consumer confidence for January the very next day, and this was a big plunge, almost 10 points, from 94.2 the previous month in December to 84.5, and also way below the expected forecast. So, and this of course had its own impact on the market itself. Nothing to be concerned about on Wednesday. The interest rates remained unchanged. So and apparently, even though the press conference in terms of guidance for the next few months, there was nothing special, and understandably so. The Fed chairman Jerome Powell is leaving his post in the next few months, and he's going to be replaced by Kevin Warsh. Now it is confirmed, and apparently, as you'll be able to see, this was something that the markets enjoyed, or at least liked the decision, but we'll get to that in a minute. For Thursday, nothing really special in here. 209,000 jobless claims, so this was more or less in line with the previous readings, so nothing to be fancy here. And here also, nothing special here. This is about also a delayed data, so this is not really important. But there was a big hit to the market on Friday, also because of this. The PPI, which is a producer price index, even though of course this pertains to December, but still it was a very big increase. This is the the data for the month, the monthly data. So it rose from 0.2 in November to 0.5 in December in the headline, and of course higher than the expectations. And even the core was 0.4, so quite a long way above the previous reading. And so, as you could have the opportunity also to see in one of the videos that I did previously about the economic data and how they influence the markets, producer price indexes is not as important as the consumer price index, but this it kind of signals what you can expect for the future in terms of consumer prices, because as you can expect, when producer prices increase, the companies will tend to reflect those increases in price to the consumers, obviously. And so we may expect that this may have some ripple effects on consumer price index a little bit further down the road, even though on a year-over-year basis, nothing changed, so pretty much the same thing. And so, yeah, even though this and quite surprisingly so, the Chicago Business Barometer, this is an intensity index, so 54 above 50 means growth, and so this was a positive signal for this barometer, for the PMI, for the manufacturing index. And yeah, this is in stark contrast with what has been happening in the past few months, but still, this was not enough to stem the bleeding that came on the back of this piece of information, because as you can expect, this is more correlated, or has more of an effect on interest rates, which is a focus point of investors. Now, this was on the economic front. On the earnings side, it's important to note that there were several companies reporting this week, but even though the results were for the vast majority positive, Tesla rose because it exceeded analyst expectations. Also, Meta, the company that owns Facebook, also beat expectations of the analysts. But Microsoft, even though it had also earnings and revenue beat, the fact that there was some slowing in its cloud computing business, that just because it slowed, it continued to grow, but there was a slowdown. The stock dropped 7% just on post trading, on the post trading session on Wednesday. And so this is an indication that the market is pretty much stretched in terms of valuations, to the extent of, even if you have the cloud services computer growing by 39%, which is less than the 40% in the previous quarter, analysts, oh, and by the way, and this was in line with the expectations of analysts, this was enough to bring the stock down 10%. And the stock continued to come down a bit in pre-market trading on Thursday, even though by that point, when the market opened, it stayed flat, it didn't recover. But this was a sign that investors are placing very, very high hopes in tech stocks, and any hint of a slowdown, it brings the entire market down with it. And this was also the reason why, if you see here on Thursday, so the day after Microsoft released its earnings, the market had this huge downswing. This is, by the way, the graph of the Qs. As you can see, this is the chart for the week, and this was where at the end of the day, where Microsoft released its earnings, and then the market simply came down. The Microsoft situation dragged the entire market down with it. There was some of recovery. Most of the losses were recovered by the end of the session, but still, the fact that then the PPI came, and also the fact that we are on the verge of another government shutdown, unless there's some consensus between the Democrats and the Republicans on Congress, all these fears led to the market coming down on Friday, and came down also in a big way. Anything else? This is the producer price index. This is a piece of news that I spoke about. Yeah, again, U.S. government partly shut down, because specifically, because of the situation of not having a consensus in terms of the Congress, and also because of the situation with the PPI. This is the current situation of the Fed funds futures for the next meeting of the Fed, which is on March 18th, and again, a very, very high probability that interest rates will remain the same. Also because the U.S. President Donald Trump announced that Kevin Warsh will take over from the Fed, and apparently markets liked this nomination because he's seen as a little bit more of a hawkish, meaning he does not want to have interest rates too low, and he's expected to keep some degree of independence for the Fed and not be one people that would be highly influenced by the whims of the US presidents. And so markets like that. As a result, the dollar recovered some of the losses that it had during the week. Here, it was at one point it went down. The dollar plunged down to 120 before it recovered to between 190 and 180. But still, it was something that investors enjoyed. But even though, notwithstanding that situation, the market still came down in a big way. Now, and as you can see here, the Nasdaq, and by extension the Qs, hit the high point of the week at 636.60. Now, and going back to the situation of our portfolio, there was a point in time, if you recall, we had the calls for the Qs with a strike of 630. So those calls were very much in the money midweek. There was a point in time in which these calls were trading at around 8. No, these are not the ones. Yeah, these were from the week before. I don't have it in here, but I can show it in here. So yeah, these were the calls from the Qs. At this point, keep in mind we sold these calls at 235. There was one point in time in which they were selling at around, they were trading at around 8. But because then the market came down in a big way, they ended up expiring out of the money. I let them expire. I did not roll over the position, so we kept the premium for us. And so for the week, we collected a little bit over $1,650, as you can see here. Now, my expectation for the IWM calls, as I mentioned, was that we would be able to roll down from 267 to 266, which is our cost basis over here. But unfortunately, this was not possible. Here, as you can see, I bought those because it was my intention to roll over. But to give you a bit of a context, and this is something that left me a bit frustrated, this is the graph for the week. And I was sure that, keep in mind, the last big volatility event was Tesla earnings. Yes, I believe it was Tesla that announced its earnings on Thursday, if I'm not mistaken. I believe it was. It doesn't show anymore. But I believe it was Apple. Let me see. I believe it was. Yeah, it was. Let me see here if I can find it. Yeah, I believe. Yeah. V's over here. Yeah, Apple. Yeah, it was Apple. Yeah. So my understanding was that we are going to let this situation pass, meaning we're going to let Apple release its earnings here at the end of the week, at the end of Thursday, and then I assume that there would be no much of a surprise on the PPI, and the market would hold steady here at around 262, 263, so that then I could roll down. the calls from 267 to 266 strike price. But as you can see here, the market plunged since the beginning of the session. And as you can imagine, because if you know the Greeks, and showing here, for example, a 267 call with a 266 call, as the prices plunge down, this one has less value than this one for obvious reasons, because this is more out of the money. But as the stock comes down, this one, because it has a higher delta, because it's not so much out of the money, this one loses value much faster. And as a result of that, the difference in premiums between this one and this one becomes much smaller. And due to a question of timing, I must have sold, I must have bought back those calls, which I bought at 4 cents. It must have been at around this time here. So yeah, it must have been around, I think it was around this time. And the reason for that is that I was going to buy, I bought back at 4 cents here, as you can see, and my expectation was to buy it at around 10, 11. It was still possible by the time this trade was filled, but the market immediately after, like a second or two after, started to come down by a lot, and in a matter of not even a minute probably, I would only be able to sell this 266 call for 5 cents or 4 cents, and so I would have to sell back and receive the same price at which I bought these, plus the commissions that I would have to pay. So there was no sense in doing it, and so I decided to sell instead the calls on 266, which would expire on Monday, still just to collect some premium on this. And that is why we have these calls here still remaining. All right, even though they lost most of the value, I could have bought them back before the end of the session, but for some reason I did not. I decided to wait. But yeah, yeah, probably the price can recover on Monday. We'll see what's going to happen. I decided not to do it, and so yeah, we'll see. Now, in terms of the ARKK, and you can see here, I was assigned the shares, and the reason I was assigned the shares was because of this. The market came down, the price, the stock came down all the time along the week, and especially here it was, by the way, this fall was around 2 to 3% on Thursday, and then another 3.85% at the end of the week on Friday. Keep in mind, we sold Delta 11 puts, so we were very conservative on the price, and still we managed to get assigned. Just for you to have an idea of how risk off the market was. I'm going to put here the 0.85 because this is the difference between our strike and the current share price, 74.65, but it doesn't matter, it's a market value. It's a mark-to-market detail, so it doesn't really matter. Because of the high volatility of these shares, I will most likely not sell the calls on 75.5, which is our cost basis. I will most likely try to sell at a higher strike price, because if the stock recovers, and keep in mind we have 300 shares, for each dollar we go above the 75.5, we earn $300. So chances are I will be shooting for something around here, 76.5 or 77, because I think this is a pretty easy or pretty accessible price for ARKK to achieve over a week, and by doing so we may be able to get some capital gain on this. So as you can see here, this, for example, even this would give us a capital gain of around of exactly $300 and a probability of profit 71%. So this is not that high. I will be, unless something happens here, which, for example, another drop in the price pre-market, I will be unless that happens, I will be shooting for around this strike price. Now, for the other ones, we are pretty much addressed for Monday in terms of the IWM. For the Qs, it's going to be the same thing. It's only a matter of see what kind of maturity are we going to choose, but we will be for sure choosing the 630 for obvious reasons. I'm gonna have to see what is in as the next week has in store for us, because I believe there may be something. Yeah, ADP may be important. Oh, and we have jobs data coming up for January. Oh, this is a big one, and this basically is going to not settle the deal, but is going to make our decision much easier. In all likelihood, we are going to sell our calls on the Qs for Friday expiration. Same thing with our IWM shares, or same thing for our IWM shares. After our calls, either these calls over here expire worthless, or if we simply buy them back. So this is something that we cannot miss, because it's too good for us to let it pass. And I think pretty much it, unless except for one final detail. I sometimes I receive comments from followers or messages rather on LinkedIn, for example, saying that this strategy, the wheel, does not beat the market. And that is true. This strategy is not intended to beat the market, because as you can imagine, if you are constantly selling options, either puts or calls, you are in some way capping your potential gains. So you can never reap big gains on big swings of the market. So this is not a strategy to earn big profits, but it's a strategy that allows you to smoothen out your returns. When the stocks come down, you lessen the pain with covered calls, because the calls will lower your losses. But if the stock goes up, you don't get as much of a return, because you are, for example, if you sell covered calls, you are capping your gains. Or if you sell puts and the puts expire worthless, all right, you get the premium, it's your return, but it's never as much as most of the market increases. But it's, as you can, because of this, it smoothens your returns. It makes your returns less volatile. And I think the best way to demonstrate this is that you can see here, for example, for the Qs, these shares were bought at 630. And keep in mind, these shares were bought on October the 31st, and since that point you see that the market never returned to 630 or above this week. And even so, the market was not able to hang on at this price, and it came down and finished the week down by quite a long way from the 630. Now, anyone who is holding these shares has not been able to get additional return on these shares since, let's just say, October, because the price never came back and stayed at 630. And as you can see here, I sold here puts on the Qs 630, 624, 627. So this means that the market was either at 630, around 630, or a little bit above. So you get the point. But because of I've been selling calls all the time on these shares. Now we currently have a cost basis of around $614. So we could break even by selling it at this price, 614.39, because of all the premiums that we received. This is a little bit less than $16 per share. And because we have 500 shares, this means that this is almost $8,000. Now, the returns are not that great. I can tell, because if we take out all the filters here and we select only the Qs, and we filter just for, we don't need to filter, we have here, you see, since all the covered calls had a return that goes here pretty well, I would say 86, here a little bit less, but some of those returns when the market was really down at around 590, 580, these returns were almost meaningless. All right, but then when the stock started to recover, the returns improved, then it came down again, and now they have improved again. Now, while any other investor has been, oh, and by the way, forget about, I think I need to take out these covered calls, these puts, only the covered calls matter. So here, as you can see, it improved a little bit, not too much, but this is all the money that investors that invest only in the shares are never able to see. And this is the cutoff, yeah, since here, this is 86. So, and this is only possible if you sell calls on the shares, either because you follow strictly a covered call strategy or because you trade the wheel and you own the shares. So this makes it very clear that yeah, while a person who only buys and holds and doesn't do anything else for 3 months hasn't seen any return on his shares, we have been collecting money and enhancing our returns every single week. And this is why the strategy is good. This is where the strategy shines, is when the market is having pullbacks, because we keep getting returns out of it. Not when the market is constantly on the rise. When it's constantly on the rise, we underperform, and we over deliver, or we overperform the market, or we beat the market when the market has these pullbacks. So this strategy has its advantages, of course, also has its shortcomings, but that's the way it is. And this is, of course, I think this is one of the main topics that sometimes get brought up to me. I hope this makes it clear for everyone. Now, this is it. Feel free to leave your comment section your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we will reconvene either on Monday evening or on Tuesday morning to see what the week is going to be like. And yeah, I'll see you there.